About 2 months ago, someone emailed me wanting to know my philosophy on investing, and I wanted to email the person back with the fewest amount of words. And so what I emailed back to this person was I said, news follows price, opinion follows price, and emotion follows price, meaning price is probably the most important part of investing. And as the price moves up, and if you own the thing that's moving up, then your opinion follows the price move up, your emotions follow the price move up, and news follows the price up. And if that thing you own is falling in price, then your opinion, the news, and emotion follows that. So price is a pretty important part to investing, and depending on the time frame or the frequency, that can be good or that can be bad, meaning sometimes the price is not always going in your direction. So what I want to do is talk about the price of gold specifically because that has been falling. It's actually ended higher on Friday, but it was down for the week, and it's down for the quarter, and it's down for the year in a very significant way. And so a lot of people's opinions, emotions, and news has been following the price down. And so I think we should look at that to really see what's going on with it. So that's what I want to talk about in this week's market situation report. Now, the funny part of me thinks that it is actually a pretty good week if you are a wedding planner who specializes in gay weddings and who also shorted gold. This would be a really good week for you. But the Swiss bank UBS came out and said that if quantitative easing ended, it would basically make gold obsolete. And I just love these big banks. They've been wrong for so long, but because they've been around for so long and they have great branding, people still listen to them, even if they've been wrong for so long. And I'm sure UBS is a completely insolvent bank. They probably owe way more than they have in assets. And I'm only saying that from a high probability point of view. But I just love it when people then start coming out saying something that's been around for 5,000 or 6,000 years is all of a sudden going to go obsolete. The other thing I wanted to talk about was the puke moment for gold. And all resource stocks, the sector itself goes through a puke moment. We're hopefully in that right now, meaning I hope we clean it and go through the whole thing. I think it started back in April, but then it got stopped, and then it started back up again. Even though gold is up on Friday, it's down for the week. And I will show you why I think my near-term bottom gold price is about 1,040. Doesn't mean it has to go there, but I'll talk to you about why I think it may go there. And then the last thought, it is actually not my last thought, but talk about stupid news. I think this was on MSNBC. Stocks and bonds are rallying because QE will not end. And gold is falling because QE is ending. I mean, you can't have it both ways. I don't actually think QE, quantitative easing, money printing, is ending. I think Bernanke floated the idea out there that somewhere in the future we'd like to stop it if the economy improves, if unemployment falls, and if prices go up. But if it doesn't, I'm not pulling back on it. At least that's what he said. So let's talk about some of these thoughts. And before we do that, I have just one more thought for you. And I really do see how this is going to end. This is how everything will end. So here's my final thought, or it's not actually my final thought. Central banks need inflation. I think everyone who's been in the stock market, who has done any reading over the last 3, 5, or 10 years knows that central banks absolutely need inflation. And the easiest way to do that is to increase the price of gold. And that, I think, will be their last move. But first, it probably needs to fall before it goes back up. So let's talk about gold and what's going on with it. So if you look at the screen here, this is a price chart of gold going back to the beginning of 2001. And you can see two lines. You can see a horizontal line that represents the peak of the price of gold in 2008 and how it could not break above that until the last part of 2009. And then it kind of fell back on top of it right here at the beginning of 2009 and then just absolutely took off. So really the next major support for gold is that 1,040 price, and that also happens to be the same trend line of gold. The trend of gold was on from 2001 to 2005, and then gold took a steeper trend up, but I think it's going to pull back to that overall trend. So that gets us to about 1,040. Now, does it stop at 1,040 today? End of market, it closed at about $1,230. It did get as low as $1,199 this week. I don't mean to get too detailed because we don't actually need to, but I don't think the fall is over. I think it has fallen pretty fast quickly, so there's probably going to be a couple days where it recovers. But I think we could have probably another 15% more downside in gold. And the only way I would revert this or say that that is not true is if the hedge fund community started covering their short positions on gold. That would be the thing that would really turn it around. The second thing I want to show you is the precious metal mining stocks. I think precious metal mining stocks have about another 25% more downside to it. And the reason I say that is there's not a lot of support between where precious metal mining stocks are today. And what you're looking at here is the Huey index. But it could very well be that the next place down is about 150 on this precious metal mining index. And that wouldn't be not necessarily historic in nature. I mean, resource stocks have huge moves to the upside and the downside. And a 25% more move is actually not that much bigger of a move down. And precious metal mining stocks fell, or they were lower for the week, for the quarter, and for the year, even though they did rally on the very last day of the quarter and of, I guess, the first half of the year. Then lastly, I just want to show silver. And again, I'm just showing you these three because no one really knows where precious metals are going to bottom. But what I think you could all agree on is that the amount of manufactured and manipulated intervention that's been going on since 2008 is at historic lifetime Earth time records, has never been seen before on this planet. And what all this manufactured manipulation has done is increase the volatility. Things are going up much higher than they normally would have gone, and things are falling much farther down than they ever would have fallen. And we will see that absolutely with gold and silver and precious metal mining stocks, and I think we're in that right now. And you also have to remember, precious metal mining stocks were actually pretty poorly run the last 10 or 12 years. The management of them did a bad job of managing expenses. They did not cut expenses. They did not limit back capital expenses. They had many bad purchases over the last decade. They're just starting to write them down, and all that bad news is coming out. And what we want to see really is when the bad news continues to come out but the price doesn't fall, then we know we're near the bottom. I'm guessing on silver's downside is 30% more because honestly, silver is almost a leveraged play on gold. And if gold's going to fall down to 1040 from 1230, let's say another $190 or another 15%, the next major support for silver really is at about the $15 mark. Again, not that it's going to go there, but the momentum is still down for precious metals and precious metal mining stocks. And with this increased volatility, that's the direction of the momentum at this time. Now, I've shown this price chart once before. This the top part is the red line is showing you how many shorts are on the COMEX gold. And it doesn't necessarily matter what the absolute line is, but this price chart goes back to 2006, and you can see the amount of hedge funds and individuals and entities that are shorting gold on the COMEX is the highest it's been really since 2005. And really until they start closing out of their shorts, which of course they will, we're not going to see gold bottom out. I've done some research on the average cost, the average dollar cost per ounce to pull an ounce of gold out of the ground, and I've seen, my research has basically told me from the industry it's anywhere between about $1,100 to $1,300 an ounce. Now this screenshot you have here is from Casey Research, and they say the industry average is about $1,300. That seems a little bit on the high side, but let's just split the difference between $1,100 and $1,300 and say the average miner is now costing them about $1,200 to get an ounce of gold out. Well, that means gold can't spend that much time below $1,200 an ounce. It doesn't mean it can't go below. It can go below, but it just can't spend that much time below, because if it does, then mining companies will start shutting down some of their mines that are the more expensive ones until the price rises. So clearly there is a bottom to gold. Gold has never gone to zero. No commodity has. and these ridiculous, stupid news headlines that come out from MSNBC or UBS or Goldman Sachs, remember, they all follow the price of gold. So as the price falls, their opinion, their news, their forecast follows that. It follows the momentum. But I will also, and I'll add one more thing, that June and July are historically bad months for gold. So we are hopefully going to finish out this puke moment here. We're through June. We have July. I don't think it has ended. So just hold on. We're almost through this. Because the opposite side, when we get to the other side of this, last time we had one of these puke moments in the 70s, gold fell 50%. And then when it got to the other side of that, it went up 800%. And I'm not saying it's going to go up 800% this time, but if it did, we'd see about $8,000 gold in front of us. Last thing, the demand of physical gold continues to go up as the price goes down. Now, if the secular bull market in gold was truly over, we would not see demand going up. I've never, ever, ever researched any secular bull run of any asset where we had demand going up as the price was falling. And all you need to think about is tech stocks in 1999 and 2000. Demand fell as fast as the price fell. But as price is falling with gold, demand of physical gold is going up. And the screenshot you see here, the red line, is how many physical ounces of gold the COMEX warehouse has on hand. Meaning, when people are trading their futures, their gold futures on the COMEX, they're taking delivery. They're taking their gold delivery. And the COMEX inventory has fallen from above almost 12 million ounces down to about 7.5 million ounces. There will be a point where the COMEX no longer, people can no longer liquidate and get gold. They will be cash settlements in the COMEX, which means there'll be no more futures because there'll be an entire cash market. So we're moving in the direction we want to move, and we have to go through this kind of this dark period to get there. And I know it's painful, but just stick with your strategies. And if you followed my approach to be diversified into, 2, 3, 4 different strategies, then that will have you survive this correction. One of the things I talked about last week was I want to know what sectors and asset classes do well or thrive in higher interest rate economy. And given what Bernanke said, 2 Wednesdays ago, it looks like higher, not high, but higher interest rates may be here to stay. We're not going to have the 3.5 30-year fully amortized mortgage anymore. Maybe it's going to be 4% or 4.5, which still is very good for the housing market. It's still very good for people because on a historic level, that is still incredibly cheap money. And we want to see a higher interest rate that stabilizes so we don't have the speculation in housing or in stocks or in bonds. We want to get rid of that speculation, and a higher interest rate will actually do that. So the question I want to answer at my next July monthly gathering, the strategy gathering coming up on July 9th, is what sectors and assets actually thrive and do well with higher interest rates. And I've identified 5 sectors that I'm going to share with everyone on that, so I'm pretty excited. You guys have a great weekend. Love your kids. Kiss your husband. Kiss your wife. And I will be speaking with you next week. All right, you guys take care. Bye.